in the construction industry, then I don't have to tell you two things. One, the industry's been hot, and two, your premiums are exorbitant. So this is an area we've been doing a lot of work in over the past, with ebbs and flows over the past 15 years. And definitely there are periods of time when the construction premiums have gone up, and then we're in a softer market. I won't say a soft market because we really don't see a soft market in construction that often. And the number of carriers, depending on the state you're in, with right to fix laws. California's SB 800, or you have New York labor law, 42, I think, 40 or 42. The carriers, the available choice of carriers that you have keeps getting smaller and smaller and smaller. And for when they're the only ones there, they can charge a lot more money for their premiums. So we have a fair amount of larger construction clients who have just decided, you know what, we're tired of falling to victims to the traditional insurance industry. And for that, they decide that they want to go into a captive insurance company. Now, most of the requirements, most of the contracts they have require rated paper. So this is another scenario where we have to go out to a fronting carrier, and a fronting carrier is merely a company that issues the policy on behalf of the client and then reinsures all of that risk to the construction company's captive insurance company. And then the captive goes out and gets reinsurance. And, the choices are, there's a lot of choices for reinsurance globally that like construction as a risk. Our larger construction clients have seen premiums go from 200 to 600%. And that's when they say, you know what, we're tapping out. When they're paying $1.8 million for a $2 million primary policy, they decide that they could do it cheaper somewhere else. They look at excess in the construction market has gone crazy. So that it's not uncommon to see somebody paying $1.5 million for the first $5 million of coverage. What we do with a captive is we take a look at all the projects they're doing and then see what risk does it make sense to put inside of the captive insurance company. We don't often put all of the risk inside. Builder's risk is still a policy where it's, depending on where you are again, it's relatively inexpensive. So you could find yourself in a situation where you're paying for a $25 million builder's risk policy, you're paying $200,000. Well, I would never recommend a client take on $25 million in risk to save $200,000. The juice just isn't worth the squeeze. But when you're looking at $1 million for a $2 million limit, or $1.5 million or $1.8 million for a $2 million limit, that's something where it warrants a deeper conversation and understanding of the project and the risk. And let me give you a real life example. Let's say you're doing a commercial building. It could be an office building. It could be, some sort of commercial building. It could be a stadium. We have people that do racetracks. But let's say it's an office building, and it's going to take you 2.5 years from start to finish on that project. Well, you pay the insurance up front. So you, as the contractor, you go out and you buy the insurance that protects the construction of that project. So you may pay today because you're touching dirt tomorrow, and it takes you 2.5 years to get that done. Well, that's when you get your certificate of occupancy, and then your required statute of limitations, depending on the state, kick in at that point. So if it's, some states are 15 years, California, New York, they're 10 years. And so now you have 10-year on the hook, 10 years for construction defect. Now you're 12.5 years from when you paid the premiums, because most of these claims get filed in the last year before the statute of limitations runs out. And now, so you're 12 and a half years into it. It takes another couple years to litigate till somebody has to pay, if you have to pay. So now you've paid $1.5 million or $1.8 million for $2 million worth of coverage, and you pay the premiums today, and the insurance company isn't paying out for 15 years. Well, that's a long period of time for them to be sitting on your money, because just using the rule of 72s at a good rate of return, your money is doubling every 10 years. So if you paid that $1.8 million to your own insurance company, well, 10 years from now, that's worth 3.6. If it's 15 years, then you have half of that period of time. So that's another $1.8 million. So you're talking about, close to $5 million for a $2 million policy limit. And that's the way these are priced. So there's a lot of situations where it makes sense for a construction company to create their own captive insurance company. They pay the premiums to the fronting carrier again, because your banks and investors are going to want rated paper in 99.9% of the cases. You pay the fronting carrier, they take a small fee, and then they reinsure to your captive. Well, your captive, if you're doing workers' comp, if you're doing construction defect, if you're doing excess policies, well, you don't want to take on all that risk yourself. We have projects that are $250 million and they need coverage for that. We draw the line in the sand with reinsurance to say we're taking the first $1 million of every claim up to 5 million total. And then, so any claim above $1 million, a reinsurer is on the hook. When the captive's total payments out reach $5 million, another reinsurer steps in and they're saying, you know what, we'll cover those claims out of your 5 million. You pay for those reinsurance, but in many situations, it's more cost effective to do it. And it's so many of our construction clients, they don't, eat the elephant, at one sitting. So on one project, for 1 year, we may say, this year we're going to start with the general liability because that's your issue. And then next year we do the general liability and we add on the excess policy. And then a few years go by and then the group medical insurance gets super expensive. And we say, you know what, let's start looking at that. Over time, what we found is if you're a successful contractor, there's never a good time to go back into the traditional market, whether it's for health insurance, workers' comp, general liability, excess policies. Once it's your own insurance company, then you have the ability to do those insurances for yourself. And it's usually much more cost effective. But let's tell you about the outlier, where it's not cost effective. Every single year, when it's your insurance company, you have an actuary that does the analysis. And the actuary says, based on your claims, based on the litigious environment you're in, based on unions, based on whatever set of factors, we think that your cost for keeping this risk in your captive is $1.2 million. That's your internal cost of risk for your captive. Now, if a traditional carrier comes in and says, we're going to do that layer of coverage for $700,000, well, we would recommend you as the business owner to buy that for $700,000. Why keep a risk that's more expensive for yourself in your own captive if there is a new player, or carriers sometimes decide, they want to buy a line of business? Well, we would recommend all day long that if the internal cost is higher than buying from the traditional market, we recommend you just say, we're going to buy in the traditional market. And we have clients that do that. It's funny. We're talking about construction and we're talking about excess policies, the general liability, commercial auto for contractors, depending on how many power units and trailers you have. But often we find this with medical insurance, where clients are saving money in their own captive structure for medical. But because of a new player, because of something, or a carrier just deciding to buy risk, that they will charge you less for the insurance than we can tell you the internal cost for that is. So we have clients who actually they may do captive for a few years, and then it makes more sense for them to go to the traditional market. That only lasts usually a year, maybe 2 years, because insurance companies, they'll lower the price 1 year to get you as a client, but then rest assured the next year you're having a 30, 40, 50% increase on your premiums. And then at that point, it's more cost effective to go back into your captive and go and get reinsurance and all the other benefits of having your own insurance company. So that there are so many different policies we have to look at when it's a construction business. It could be environmental, workers' comp. I mean, there's a lot of tiny policies, and based on the state, very specific language that needs to be added in. And the good thing is we have the expertise to make those recommendations. But if your premiums are increasing and the exclusions list is also increasing, which is very common these days, then it's at least worth considering and going through the discovery process to see, does a captive make sense for us and our business as a long-term solution?
Yeah, Wes, I was just going to add to that. I'm sure you recall, I think it was around 2014 when we engaged that company, the New York Construction, and Labor Law 240 and 241 were hitting New York construction in a serious way, which is a very much longer conversation than for right now. But if my memory serves me well, the expiring premium for their workers' comp and general liability was around 2.2 million. And the renewal, because a lot of the players were exiting the market, a lot of the insurance options, was 4.8. So it was 4.8 million for a guaranteed cost. And we went in and got them a self-insured retention for $100,000 for each of the lines. But we also had an aggregate on top of it of 3 million. And the beautiful thing was the fixed expenses, forget about their potential claims exposure, but their fixed expenses dropped by 3 million. So 1.8 million compared to 4.8 million in fixed costs. And then they had a $3 million aggregate exposure. So they'd have to, with $1 million per occurrence. To us, this was a win-win, and to the client it was as well, because obviously the exposure wasn't greater than just paying 4.8 million and getting a deduction. So what we did was we took a layer of that risk and we put it in the captive. Thankfully, over the first handful of years, they had great experience. Claims were low. And actuarially speaking, it looked like they didn't have to reserve as much. So we had some capital freed up inside of the insurance company. And then we went back to Chubb, which it was ACE originally when this all began. And we were able to utilize some of the excess capital inside their own insurance company for the collateral piece as well. So just adding, there's a lot of benefits with the captive, a lot of different options in regards to lowering your fixed costs and really benefiting the business long term.
Yeah, and I just pulled it up right now, and it looks like, because it was 14, 15, and this has been a long-term successful project, but it looks like as of the end of last year, their checking, savings, and assets are $24.9 million in their insurance company, but they do have some claims that are sitting there on their books, and those claims are in the $5.2 million range. So even if they had to pay out those are probably, even if they had to pay out those claims, it's, there's still $20 million to the positive versus where they were had they just paid the traditional insurance marketplace. So yeah, I'm glad you brought that up, and it just triggered my mind to say, what is their stuff? Because I haven't looked at it in a few months, but that's a significant, and it doesn't matter because construction is so competitive that there's a lot of people that are just living on thin margins at this point to keep their crews working because there's less construction projects. But to be able, on top of their profit from their construction business, to be able to put to the sideline $24.947 million in cash. And I haven't even looked to see if they pulled out dividends or where anything else. I'm sure they have, but that to me it's just such a powerful tool to exit the traditional market and take control back. Write policies that cover you for the risks that you have in your business and pay the claims that are legitimate to pay and deny the claims that are legitimate to deny. And it just, it's fascinating. So thanks, Bryson, for bringing that back up.
Yeah, actually, I'll throw one more thing because you talked about it earlier about, eating an elephant. A few years later, after some cash accumulated inside the captive, we decided to take them self-insured on their health insurance, their medical plan, because they had the confidence. So, it was piece by piece. So, yeah, it's a very successful client.
Yeah, their total equity in their insurance company after everything is about $19 million right now. So to me, that's been a huge success.